The 2022 Berkshire Hathaway Annual Meeting just took place. This is the business that Warren Buffett and Charlie Munger are the owners of. Investors treat this annual meeting like a pilgrimage, and people from all over the world, they travel to Omaha to see these two guys speak. Now, in today's video, I want to highlight the 5 key takeaways from this meeting. These are ideas and lessons that I thought were extremely important to learn and remember. Anyway, with that said, let's find the 5 key takeaways from the Berkshire Hathaway Annual Meeting.
If you told me you owned all of the Bitcoin in the world and you offered it to me for $25, I wouldn't take it, because what would I do with it? I have to sell it back to you one way or another. I mean, they have the same people, but it isn't going to do anything. The apartments are going to produce rental, and the farms are going to produce food. And if I've got all the Bitcoin, I'm back where whatever his name was, who may or may not have existed, was 15 years ago. If I've got it all, he could create a mystery about it. But everybody knows what I'm like. I mean, so if I'm trying to get rid of it, people will say, well, why should I buy some Bitcoin from you? I mean, why don't you call it Buffett coin? Make your own or something. What? Do something. But I'm not going to give you anything for it. And you'd be right, incidentally. But that explains the difference between productive assets and something that depends on the next guy paying you more than the last guy got.
Buffett calls Bitcoin a non-productive asset because it produces nothing. If you own a farm, it produces food. If you own an apartment, it produces rental income. But when you own Bitcoin, it produces nothing. And because it doesn't make an income, the only way to make money from Bitcoin is by finding someone who's willing to pay you more than you paid for it. Buffett makes a very interesting thought experiment. He said, what if tomorrow he owned all the Bitcoin in the world? It became his personal coin. So much so he could call it Buffett coin. If it were the case, would it still be worth as much as it does today? I think what he's trying to highlight is that a lot of the value of Bitcoin is from the fear of missing out. That certain people have it, and others that don't, they're willing to pay a lot for it. In Buffett's thought experiment, if he was the only one that had it, and everyone knew only he had it, would they still be willing to pay as much for it as they do now?
There are more difficulties of dealing with the regime in China than there are in the United States. And it's different, it's a long way away, and they've got their own culture and their own loyalties and so on and so on. And the reason that I invested in China is I could get so much better companies at so much lower prices, and I was willing to take a little political risk to get into the better companies at the lower prices. Other people might reach the opposite conclusion, and everybody is more worried about China now than they were 2 or 3 years ago.
Munger says that the reason he invests in China is because he can find great businesses at much lower prices as compared to the US, even when accounting for political risk. And this reminds me of something that Howard Marks once said. He said, no company is so good that it can't be overpriced. And the opposite is true. No company is so bad it can't be underpriced. Munger seems to think that the fear towards China has now tipped the scale to make great businesses in China extremely undervalued.
We haven't the faintest idea what the stock market is going to do when it opens on Monday. We never have had. We have never made, Charlie and I don't think, in all the time we've worked together, and I'll tell you something later on maybe about how learning takes place, but we have never, I don't think we've ever made a decision where either one of us has either said or been thinking we should buy or sell based on what the market is going to do.
No.
Or for that matter, on what the economy is going to do. We don't know. We have not been good at timing. We've been reasonably good at figuring out when we were getting enough for our money.
Buffett admits that he has no idea what the market is going to do tomorrow, and he doesn't want to waste time thinking about something he has no control over. But instead, what he's good at is figuring out where to put his money that gets the best returns. And he does this by figuring out what the future cash flow of a business is. This will give him the intrinsic value of a business. Once he knows the value of a business, he knows whether a stock price is high or low, and that's where he makes his decision. If you want to know more about how Warren Buffett and Charlie Munger calculates the intrinsic value of a business, I've actually made a video on this, and you can click on the link above to check that out.
People say how wonderful you've done if you bought Berkshire in 1965 or something and held it. But your broker would have starved to death. I mean, it's Wall Street makes money on one way or another, catching the crumbs that fall off a table of capitalism and an incredible economy that nobody could have ever dreamed of a couple hundred years ago. But that they don't make money unless people do things and that they get a piece of them. And and they make a lot more money when people are gambling than when they're investing. I mean, it's much better to have somebody that's going to trade 20 times a day and get all excited about it, just like pulling the handle on the slot machine.
Buffett reminds everyone that Wall Street gets rich from the fees you and I pay. The more we trade, the more money Wall Street is going to make. And the times where we trade the most is when we're the most speculative and gambling in the market. This type of behavior guarantees money for Wall Street, but not necessarily us. On the other hand, if we just purchase really great businesses like Berkshire Hathaway and left it alone, we would do really good for ourselves. Meanwhile, Wall Street would starve to death. Now, Buffett is trying to remind us, don't gamble in the market, don't be speculative, because it's going to make Wall Street filthy rich.
The best thing you can do is to be exceptionally good at something. If you're the best doctor in town, if you're the best lawyer in town, if you're the best whatever it may be, no matter whether people are paying you with $1 zillion or paying you, they're going to give you some of what they produce in exchange for what you deliver. And if you've got it, and if you're the one they pick out to do any particular activity, sing or play baseball or be their lawyer, whatever it may be, whatever abilities you have can't be taken away from you. They can't actually be inflated away from you. Somebody else will give you some of the wheat they produce or the cotton or whatever it may be, and they will trade you for the skill you have. So the best investment by far is anything that develops yourself.
The best way to protect yourself from inflation is by being really good at what you do, whether that's being the best doctor or the best hairdresser in town. When you're really good, you're going to be in demand even if you raise prices due to inflation. Essentially, what Buffett is referring to is a moat or a competitive advantage. And this works for both individuals and as a business. Businesses with a weak moat, when they raise prices due to inflation, customers are going to become price sensitive and look for alternatives. Businesses with a really strong moat, and I'll give you some examples: Apple products, Coca-Cola, Tencent's WeChat. When they raise prices due to inflation, customers will stick to these products because the alternative is just not as good. I hope you got some good value out of this video. If you liked the video, you can help me out by clicking a like to this video or subscribing to my channel. Have a good week, and I'll see you in the next video.